Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 9th of April 2024. Gold is starting to look overbought on multiple time frames. Here I have the monthly chart. As you can see, gold is up 5.5% on the month following a sharp near 10% gains the month before. It is now testing the 161.8% Fibonacci extension level of the last significant downswing from the August 2020 high to September 2022 low. With gold testing these extended levels, the RSI has risen above 70, meaning that it is now in the overbought territory on this monthly time frame. So the RSI will have to come back down at some point, either because of price action, so a sell-off in gold, or through time, meaning consolidation. Now, if you thought the overbought conditions were bad on the monthly time frame, look at the weekly. The RSI here has risen to around 80 level, which is at extreme highs. The last time it did that was in August of 2020, when it then sold off and remained in a large consolidation zone for multiple years. I'm not suggesting that we will see that kind of price action again, but the RSI will need to come back down either through price or time, making gold at these levels extremely difficult to justify buying from a bullish point of view. On the daily time frame, the RSI is even extremely overbought at 85-ish. So it does need to come back down like it did previously in March, in the second week of March, when it had risen to around the same kind of levels. Then we saw a bullish consolidation pattern unfold in gold as prices consolidated inside this falling wedge pattern. And then that allowed the overbought conditions to be worked off through time than price action. That then encouraged traders to once again start buying gold, as it was no longer technically overbought. So from a bullish point of view, if we see a consolidation pattern like this at around current levels, perhaps around this trend line, so a bit of a pullback, that would be an ideal scenario from a bullish point of view. In any case, we'll need to see a bearish reversal before turning bearish on gold. At current levels, it does look overstretched, but it doesn't mean that we should be shorting gold just because of the RSI moving to the overbought levels. So we'll need to see a confirmed reversal stick before turning bearish on gold. The longer term trend is clearly bullish, so we would be looking for dips to be supported around key technical levels should we see a decent pullback. Looking at crude oil prices now, and previously I was looking for something like this to happen, and it did just that. And the reason I was looking for support to hold here is because of the length of time it had taken crude oil to break out of this zone, and I was therefore expecting a sharp continuation to the upside, which we have now seen. Now prices are looking a little bit overbought like gold, and so we'll need to see a pullback or consolidation to work off these overbought conditions. Previously, when WTI had risen to these overbought levels, we saw a sharp sell-off. Could we see something similar this time? Well, you never know. Anything could happen, obviously. So we'll need to proceed with extra care at these overbought levels, especially if you're a bullish investor. For bearish traders, we are starting to witness a few interesting looking price patterns emerge on the WTI chart. So we have had a couple of doji candles in the last 2 days, or 2 trading days. The first one formed on Friday ahead of the weekend, with traders clearly unwilling to hold on to the positions that they had accumulated previously ahead of the weekend. But at the weekend, we didn't see any further escalation in the conflict between Israel and Hamas, and that caused oil prices to weaken on Monday before bouncing back. But look how it closed, printing basically a doji candle with prices opening and closing around the same levels as they did on Friday. So this is kind of suggesting that the bullish momentum is waning perhaps, and that we could see a pullback of some sort. So from here we could well see a move lower below the 61.8 Fibonacci retrace, which has turned into support. Interestingly, I think that's just a coincidence. So 84.40 is the support level to watch. If that breaks, then we could see a move down to the $83 area, where we have the 21-day exponential moving average converging. And then if it goes below that, then this shaded area will be in focus next, where we also have the bullish trend line converging. On the upside, last week's high is the first bullish objective now at 87.30. Above that, we have the 78.6 Fibonacci extension level, and then the September high at 94.63. Looking at the S&P 500 here, and you can see that the market has pulled back a little bit from its record highs following another strong quarter, which followed a equally strong quarter in Q4 of last year, when combined the S&P rose nearly 30% from its low of October to the highest point. So clearly people are taking profit following such a strong rally at the beginning of this quarter, which may be the reason behind the weakness. Besides, we don't have many further bullish catalysts to drive markets higher, and ahead of earnings results, people are taking profit, and so the markets are in consolidation mode. Interestingly, the index has broken the bullish trend line that had been in place since beginning of this year, and it's now finding support at around an area where you'd expect it to, i.e. the 21-day exponential moving average, which has consistently provided support on every single pullback so far this year. Admittedly, we did close below it on Thursday, but that was followed by a strong recovery on Friday. However, the momentum has now been lost once again as investors await the release of CPI on Tuesday. So where do we go from here? I mean, if we get a close back below 51.80 and the 21-day exponential moving average, I think that would be bearish. If that happens, then a move down to take out liquidity below last week's lows around 51.43 could be the next downside target, followed by support at 5100. On the upside, if we go back above resistance around 52.28 area, then the next upside target could be the all-time high that was hit last week at 52.74. In the FX space, the dollar yen has been like watching paint dry. Really, it has been contained in a very small range. It's very bizarre, this kind of price action. Normally you tend to see decent ranges in the dollar yen, but that hasn't been in the case in the last few weeks, with prices consolidating below resistance at 152 and support and above support at 150.80 area. So it will need to move out of this range at some point to trigger technical buying or selling in the direction of the break. So nothing has changed on the chart of dollar yen since our last update. So let's move on swiftly to the euro dollar. The euro dollar has held above the trend line that it reclaimed last week, and it has subsequently moved back above the 200-day moving average. All told, price action is inside a large consolidation zone. It's not a trending market, and I think everyone is just waiting for the release of the CPI in midweek to make up their minds about the near-term direction of the US dollar. But for the euro, we also have the ECB rate decision to consider on Thursday, which could move the single currency across the board. So those two macro events could determine the direction of the break from this converging trend lines. If we get a break above 109 area, I think that would be bullish, especially if it can close above it. On the downside, short-term support comes in at 108.35 now, followed by the 107.95 level, and then this area around 107, which had marked the lows back in February and in December. For more market updates, make sure to check out the news and analysis section at cityindex.com.